Hello everybody, this is PillarTrading.com, and today we are going to be going over time frames and why they are important in trading, both in the long term and short term, and how they can be used and exploited in order to pull profits from the market on a regular basis. We're just going to start here with what is a time frame relative to trading. What am I talking about when I mention it in the live trading room, and what am I talking about when I mention it here? Well, if we take a look at a basic chart, this is just the US dollar versus the Japanese yen spot chart. And this is a weekly time frame, okay? What that means is every time a new week passes, a different candle is made, formed, and set in place. So each candle represents a different week of trading. The larger time frames, like the weekly or the monthly charts, allow us to get a bigger picture on where markets are headed in the long term. You can see here, dating back to 2007, we've seen lower lows on the US dollar Japanese yen. And moves like this allow us to focus in on our day trading by understanding where price is going in the long term. There doesn't seem to be any buying pressure on the weekly chart as of yet. Now, if we take a look at a smaller time frame, if we take a look at a daily chart, again, this just means that every time a single day passes, a new bar is formed. We can see that there is a little bit of buying pressure on the daily chart. Okay, smaller time frame, it's bounced twice off of a level here at the 88 evens. Now, you really wouldn't be able to see that or identify that as a entry position on the weekly chart because you are bearish on the weekly chart. But here you can sort of see that there is a little bit of bullish activity here. Okay, and that's going to alert the smart intraday trader that there are two different people trading this market. There are the people that are trading it off of the weekly charts, the long-term traders. You need to know where they're going to be knocking this market down. You need to know where they have their stops in place in order to trade profitably. You also need to understand that there are smaller swing traders in the market, and they're probably trading off the daily chart or a smaller time frame chart than the weekly chart. The weekly chart is fantastic for identifying trends. It's not fantastic for getting amazing entries because you don't have the knowledge of where the market is at in the short term. Now, daily chart, it narrows the field a little bit. You get a little bit less feel for the overall trend, but you are able to make more precise entries. Now, there are daily traders who are taking this thing up from this 88 even level. That's something you have to know as an intraday trader. Okay, we are not swing traders or long-term traders here at PillarTrading.com, but every single day, we look at both the weekly and the daily charts in order to identify where those people are probably going to be looking to get into the market, okay? Where is their next opportunity? If we take a look at the 15-minute chart, it's going to bring us down even more. This is our anchor chart at PillarTrading.com. This is what we base all of our intraday entries and exits off of, is this 15-minute chart. Well, in the 15-minute chart, you can see that there has been selling pressure, and we've since seen resistance 1, 2, 3, 4 times at this level, at this 90-30 level, okay? So the intraday trade is to the downside as well because we've seen the weekly, longer-term trend always wins out over the shorter-term trend. So you've got the weekly trend, our bias is to the downside. Daily bias is to the upside. But on intraday, because our weekly bias is to the downside, we are looking for opportunities to get in to bearish positions. We are looking to sell this market. So we are identifying all the levels where that's going to be possible and where we think there's going to be resistance from other traders. So that's how different time frames can produce different results. Okay, because you have different people trading those time frames. You have some people trading off the daily, the weekly, the 15-minute. They're all going in different directions. You need to understand where those people are coming from in order to move before they do. Okay, so that's how different time frames can produce different results. Now, why is it important to identify correct time frames in trading? Why is it important to identify the best time frame for you as a trader? You may be interested in long-term trading. You may be interested in swing trading. Here at PillarTrading.com, it's day trading only. We are liquid every night. There is no holding positions when you're not around, trusting the computer is going to take care of everything. If you can't see it, you don't trade it. Now, if we go back to the chart, in terms of day trading, all this stuff helps us out. Because like I said, I've identified where other traders are going to be in the market, and we are going to get into positions before they do, and we're going to get out of positions before they do. So that is how it can be important in understanding these different time frames. And these time frames, they go all the way down to, to a single minute a new candle is created. Now that, some people say that's too short of a time frame. You're going to get a lot of noise in that market. So in terms of risk reward, we've identified that this 15-minute time frame is the best time frame for our trading. Different strategies require different time frames, and there may be other markets that are not suited to this time frame. There may be if you trade the E-minis, a little bit smaller time frame because it's so liquid and because it moves may be required. But again, you need to take a look at your risk tolerance, because the larger time frame, the larger the stops have to be. Take a look at how available you are to watch these things trade. Are you available to sit in front of your computer all day and trade full time? If you are, then the 15-minute chart is going to be fine for you. If you're not, take a look at a larger time frame. You don't want to be trading off of this 15-minute chart. So there's different ways you can use time frames to exploit the market. There's different ways that you can use them to create your daily bias, your weekly bias, and your intraday bias. All that is important, and all that should be done beforehand. It's in your trading plan, so that when the day comes when you're setting up trades, you really don't have to think about it or look over it. It's up. You know what your levels are, and you know what your daily plan is. So that's just a way you can use different time frames. Look at it, break it down, and try and use it to exploit those trades for those days to make money. So hopefully, guys, you got something out of this video, and you're going to be able to use these different time frames in your trading. If you did, please visit the website, again, www.pillartrading.com. If you've got questions or comments, leave them, and we will try to get to those as soon as we can. Hopefully everyone has a good trading day today, and we will see you all on the trading floor.